The crypto market has been sending mixed signals. Some say the bull run is delayed, others say it's already over. And then there's the theory that it's all about Bitcoin for now, with altcoins left behind. But what if the answer lies not in the charts, but in the real-world catalysts shaping the global economy? In this video, we're diving into the macro forces that could be steering the crypto market's next big move. From Trump's tariffs and Federal Reserve policies to AI innovation and global stimulus, you'll see how traditional finance is playing a massive role in the future of digital assets. Let's unpack it all and figure out where we really stand. One of the biggest macro drivers of market sentiment right now is Trump's tariffs. These threats started gaining traction in February and really intensified in April, causing noticeable dips across financial markets, including crypto. This has sparked widespread uncertainty, with investors struggling to understand how these policies will impact their holdings in the short and long term. Rather than risk exposure, many investors are simply exiting positions or staying on the sidelines. That's resulted in a sell first, ask questions later mentality. Companies are responding by pausing hiring while consumers are saving more instead of spending. On top of that, businesses are stockpiling inventory to front-run expected price increases from tariffs. Everything from cars to electronics is being hoarded. Take Apple, for example. They recently imported over 600,000 kilograms of iPhones to avoid the added cost of tariffs. That's a massive stockpile, enough to keep up with demand for months. The unintended side effect? Inflation might actually drop in the short term due to high supply and decreasing demand, which could be good news if it encourages the Fed to cut interest rates. However, whether this is bullish or bearish still depends on how long the uncertainty lasts. The Federal Reserve has acknowledged tariffs as a significant concern. The good news? We've seen small signs of retreat from both the Fed and the Trump administration, including pauses and exemptions for certain industries. If this trend continues, markets could start stabilizing by the time the current 90-day pause ends in early July. The second major macro factor is Federal Reserve policy, specifically the potential for interest rate cuts or even a return to quantitative easing. Investors are watching this closely because lower rates generally mean more borrowing, which fuels growth in both traditional and crypto markets. Similarly, quantitative easing adds liquidity by pushing down long-term interest rates when the Fed buys government bonds. What's different now is that the Fed's rate policies and balance sheet decisions have been operating independently. While they've slowed the pace of rate hikes, they've also reduced quantitative tightening, or QT. That means they're still letting bonds roll off the balance sheet, but at a much slower pace, currently down to just $5 billion a month. That's a signal they're starting to ease off the brakes. Add to that the Treasury Department's limitations on issuing new bonds due to the debt ceiling, and you've got a liquidity crunch that's now beginning to ease. There's still money moving into the system, but because of uncertainty, especially around tariffs, it's flowing into safe assets like gold rather than riskier ones like crypto or tech stocks. Still, the setup is there. If the Fed announces on May 7th that it's ending QT or even just holding steady while inflation softens, that could significantly support market liquidity. They've already signaled an intention to reduce rates below 4% by year-end. If inflation continues to drop and the job market cools, we could see cuts even sooner. That's a scenario where crypto could thrive again, especially altcoins. Beyond the US, we're seeing stimulus signals from other major economies, another macro tailwind that could impact crypto. China is considering moving up its stimulus timeline to counteract the effects of Trump's tariffs. If they follow through, it would unleash a wave of liquidity, potentially benefiting global markets and risk-on assets like crypto. Germany is also in the spotlight, preparing to spend 500 billion euros on various initiatives after forming a new government. That money will likely go toward infrastructure, industry, and green tech, all of which stimulate economic activity and increase cash flow. European markets have already responded positively, with stocks rallying as soon as the news dropped. The important part? This kind of government spending doesn't stay local. Stimulus in one country often boosts demand in others through trade, investment, and financial spillovers. So while Germany and China aren't directly investing in crypto, the extra liquidity they create could eventually trickle down into global assets, including digital currencies. And it's not just those two countries. We could see similar moves from other nations facing slower growth or inflation pressures. When central banks and governments around the world start loosening monetary conditions at the same time, the net effect on liquidity is significant, and historically, that's been bullish for speculative assets. Another surprising market driver, AI innovation. Much of the stock market's rally over the past couple of years has been powered by just a handful of companies, the so-called Magnificent Seven: Apple, Amazon, Meta, Google, Microsoft, Nvidia, and Tesla. These companies account for over a third of the S&P 500 and nearly half of the NASDAQ 100. And the main reason for their gains? Artificial intelligence. The launch of tools like ChatGPT sparked investor excitement that pushed AI-related stocks into overdrive. But in January, the launch of DeepSeek, a Chinese open-source AI model, cooled some of that hype. It showed that the U.S. tech giants might not have as big a lead as investors assumed, and that caused a bit of a reset in valuations. However, new AI milestones could reignite the rally. GPT-5 is rumored to be close to artificial general intelligence, AGI, and its release could be a major trigger. Tesla's upcoming full self-driving update and Apple's entry into the AI space are also on the radar. Add Meta's Llama 4 and custom AI hardware from Amazon and Google, and you've got a pipeline full of potential catalysts. Why does this matter for crypto? Because crypto often follows tech. A rally in AI stocks lifts broader indexes, which in turn boosts investor sentiment across the board. And with crypto still being a high beta asset, it tends to benefit more than traditional equities when risk appetite returns. So what have we learned? The macro stage is set. Whether it's the Fed easing policy, governments ramping up stimulus, or the next big leap in AI, every one of these developments has the potential to influence crypto prices in a big way. But the question remains, will all this liquidity and innovation make its way into crypto, or will uncertainty continue to dominate the narrative? In part 2 of this series, we'll shift our focus from traditional finance to the crypto-specific catalysts that could drive the next bull market, from ETF approvals to stablecoin regulation, and more. So if you want to stay one step ahead, make sure to catch the next episode.